Hi class, this video is going to continue our series of videos on evaluating financial performance, but this one is going to specifically focus on gearing and stability, which comes down to this concept of debt and how we analyze how much is too much debt in a business. In terms of the textbook, you're going to find this information in chapter 23 of the Macmillan textbook on page 464 to 466. So what is stability and gearing, and how does it relate to debt? When I'm talking about stability and gearing, I'm talking about the dependence of a business on borrowed funds compared to how much has been contributed by the business owner. We're looking at, can a business meet its debts and continue in the long term? So how much is a business dependent on getting debt or borrowed funds to run its business versus how much is it reliant on the business owner giving money to fund the business? So how do we analyze stability and gearing? This is a lot of writing, but let's run through it. Stability and gearing is different to liquidity. We know that liquidity are ratios that examine the short-term future of a business entity, whereas stability or gearing, which I'll use interchangeably, relate to long-term future of the business. And we know long-term, there's only two ways a business can be financed, and when I say finance, get money to use in expanding and running its business. It can either be financed by internal funds or owner's equity, or it can be funded by external funds, liabilities, typically borrowings from banks, accounts payable, etc. So gearing is the dependence on the entity on outside funds compared to internal. How strong is this dependence? Now, a business can be described as highly geared, and this is some of the terminology we'll get comfortable using, if a high percentage of its assets are financed by liabilities. Whereas a lowly geared business is one that is financed by largely the owner's equity, so the proprietor. So it is more highly dependent on the proprietors or owner's equity funds, and hence has borrowed very little. Now, why do we care about this? Why is this part of our financial analysis? We want to understand this, and this is probably the most important two dot points in this presentation. We need to understand a highly geared business has a higher percentage of liabilities. So a highly geared business is a higher financial risk. Why? Because there is a greater pressure on the business's resources to repay debts. If you have lots of liabilities, you have more obligations. And if the expected cash inflows, the things that you're hoping to come in to repay that debt, it is still faced with the repayment of liabilities, so it is higher risk. If it doesn't get the money it's expected, the cash it's expected, it won't be able to repay its debts. But is debt bad? No. If you use debt effectively, it can be a major positive because you can use debt to expand, to build more sales and make more profit. So what do I want you to leave this video understanding? Highly geared businesses mean more debt than lowly geared businesses. This means they might be deemed more risky because they have to pay back their debts, but don't look at all businesses with high debt as being necessarily bad. It's, can they pay back that debt? And are they using that debt effectively to fund and expand their business? Now, how do we do this analysis? We assess this using financial indicators. And the stability or gearing indicator that we look at is just one. It is our debt ratio. Debt ratio here being our total liabilities divided by total assets divided by 100 to get a percentage. And we're going to look at the changes as increases or decreases. So your terminology is going to be the debt ratio has increased from 28% to 42%. Is that good or bad? That's where the art form of financial analysis comes in. When we're talking about risk, hopefully this has triggered something in your memory from previous videos. You know that return on investment is really important, and we'll come back to that in our final slide. So using this indicator, we know we have to understand debt ratio really well, and we have to understand a few components of it. For each of these indicators, hence just debt ratio here, you need to know the formula, what the indicator analyzes, is the movement, so the increase or decrease, favorable or unfavorable, what might be a good or bad value, knowing that this is not easy, what causes a change, and what could be some strategies to improve it. If you can leave this video understanding, ticking these things off for debt ratio, you can do a lot of analysis. So let's delve into debt ratio. What is it? What does it analyze? How do we determine whether an increase or decrease is bad or not? What is driving it? Debt ratio has a formula like we've discussed. Total liabilities divided by total assets times 100. Now we know you are not necessarily going to be asked to calculate debt ratio. You are going to be asked to analyze it. So what does this analyze? Debt ratio measures the percentage of a firm's assets that are financed by liabilities. So what is the percentage of the assets that a business has that are financed by liabilities? Remembering assets can only be financed by liabilities or owner's equity according to the accounting equation. And this is what evaluates stability or gearing. It has implications for risk, so the long-term stability of the business, and returns. Remember, we're going to come back to return on owner's investment at the end of this video. So for example, if a debt ratio is 56%, this means that 56% of his assets were financed by liabilities, most likely a large part of that being borrowed funds. So 50% of the assets have been financed by liabilities, hence there's an obligation for a business to do something on those. It's measured as a percentage, and generally decreases are favorable. The word generally is a really important one to understand. We're going to come back to this. To improve the stability of the business, the long-term stability, reducing our gearing debt ratio is generally a positive. But remember, the only way to expand a business often is to get debt. So it's going to be one that we're going to have to analyze. So how do we analyze it? What might be considered a good or bad value? We need to understand and compare often our debt ratio, so how much is our assets being financed by liabilities, to our returns, particularly our return on investment and other return indicators. This could be profitability, so net profit margin, maybe return on assets, other indicators as well. Because the more the business borrows, the higher the debt ratio, and the higher the debt ratio, the higher the risk and financial pressure on the business. And what do I really want you to remember? Remember, higher risk requires higher return. The more debt ratio you have, the higher the debt ratio, the higher the business return you require. So this is how we can start to analyze and understand the links between these indicators. So how do we look to this? What else can we analyze? We might also look at past trends, industry averages, etc. to be able to do some analysis. What are the reasons for these trends though? we tend to know increases are typically looked as unfavourable, or at least we need to be seeing a higher return. So how could it increase? It could be because we're relying more on borrowed funds. We've reduced our owner's investment, so maybe there's been a drawing. Or we could have had losses, and remember, losses reduce the owner's equity of a business. It could increase by the opposite. So we're relying less on borrowed funds, so we're repaying debts or using our profits to pay down debt. We could be increasing our owner's investments or increasing our capital contributions. Or we could be retaining the profits in the business, not doing them as drawings, but investing them, paying back debt, financing new assets by the profits. And using this, we can start to do some analysis. And we don't know anything more about this business, but you can start to think what you might be considering if you saw something like this. Debt ratio has increased from 45% in 2022 to 59% in 2023. It has increased, typically an unfavourable one. So what could have led to this? Any of these increases here. But would it be bad or good? We'd have to look at the returns as well. And this is where we lend to our final part of it, the gearing and stability analysis, debt ratio and return on investment. Really common exam question, really common thing you're asked to analyze. This is how I want you to think of questions like this when you see debt ratio and return on investment, or really any return indicator. Firstly, higher debt equals a higher risky business. That means we need to look at the return indicator. And particularly return on investment, we know equals percentage return on the invested funds. So how much return are you getting as a business owner on what you've invested? Now, we know higher risk requires a higher return. And that means if we have a higher debt ratio, we must require a higher return on investment. So this is how we can compare businesses and compare trends. If a business has the same debt ratio, two businesses have the same debt ratio, I'm going to likely pick the one that has the higher return on investment. But if the businesses have very different debt ratios, the return on investment, I'm going to have to look at the ratio between them. I might be happy to take a business that has 3 times the return on investment if it has only twice the debt ratio. But I might not be happy to take on a business investment that has 1.5 times return on investment compared to another business if it has twice the amount of debt. So how can we start to analyze this? We need to compare debt ratio to return on investment and other return indicators. As we know, the business borrows more, they become higher risk. The financial pressures on the business increase, and higher risk equals required return. So why do businesses borrow money if it's such high risk? Why don't they just get their owner to invest it? Simply, many small businesses don't have the wealth, small business owners don't have the wealth to contribute capital. And typically, remember, you need to invest in your business to grow it. It's just that if we're going to put more money in, we expect to see a return on that. And that's what I want you to be thinking. And this is where we come to the end. I hope that this has helped you understand how to analyze gearing and stability ratios using debt ratio. So, how can we evaluate stability and gearing, noting that this slide says efficiency when it shouldn't? Let's look at 2 quick exam questions and do some very quick analysis. This is a typical question, and this was the exam question from 2018, question 6. And you can see it's shown information in a slightly different manner. But what you've been told is you've got a debt ratio that has changed. Because in 2017, your liabilities comprised only 32% of your assets. Whereas in 2018, it was 48%. So the trend, even though it's depicted pictorially, your debt ratio has gone from 32% to 48%. And explain the implications on your profitability and liquidity. This is a question that's asking you, if your debt ratio increases, how could this impact profitability and liquidity? So it's a difficult one. Profitability could increase or decrease. If we've used this increased liabilities, this increased debt to fund effective assets, expand our business, to increase sales and increase profit, it could increase it. But if we've used this liabilities not effectively, and we still have to pay back interest because of the increased debt, it could reduce our profitability. So this is an implication that could be a good or bad thing. In terms of liquidity, can we pay back our short-term debts? Similarly, same deal. If we've used this debt to generate significant cash, it could be positive for liquidity. But it could be a very big negative if we've used this and we have to pay significant more cash. We have more short-term debts because of this. So this is where we have to analyze it, but you can understand increased debt, increased risk, and we need to see that using this increased risk to generate more profit, and hopefully it doesn't impact our liquidity too much, because typically it will. Again, in 2015, they asked a similar question. If the debt ratio increased from 40% to 70% in 2 years, we have to think about positive and negative effects. Our risk is higher. We have more debt compared to our assets than ever before. But what could be the positive effect and what could be a negative effect? Now, as we said, if we've used this debt to fund business activities that are going to improve profitability and improve returns, this is positive. But if we've used this debt and it's going to just burn in our business, it's not improved our return on investment, has not been used effectively, and we're going to have to pay more debts off, more interest expenses impacting our liquidity, it's a significantly negative effect. And this is how I want you to consider it. And this is where we end. I hope you found this video useful to evaluate gearing and stability, and particularly you've come away understanding higher gearing, higher debt ratios, higher risk, we need a higher return.